provide we provide assistance to startup and existing co-ops across Georgia with the goal of addressing the social needs of our communities and creating a more equitable economy. We work with a lot of startups with GCDC because we don't have a strong and vibrant history of co-ops in Georgia, particularly that other states have had, particularly those in the Midwest. And so we're just answering questions and providing support and networks and things like that. So, but I'm thrilled to say that it keeps me way busier than we envisioned. So that's really good news in the co-op world. But right now we're going to get started talking about a reporting system. And I know that some of you probably work by yourselves. Some of you may be going into starting a project that's formed as a co-op or a nonprofit or a partnership, right? So I'm going to talk about, what you do. I'm going to talk about principles and ideas that I want you to think about across the spectrum. So when I'm thinking about 3 guiding principles for designing a reporting system, which is going to share out your results, I think about transparency, accuracy and reliability, and education. And those things are probably not what your first initial thought would be, accuracy being top foremost. If you want your reports, you want them right. But I like to start with transparency, because when you go into business by yourself, then you can keep the books any way you want to. It's between you and the IRS, right? What you report and how you report it is all on you. But when you decide to go into business with other people, and even I include nonprofits in going into business because frequently they are competing with businesses. When you decide to go into business with other people, whether that's a co-op or a partnership or a nonprofit, then you have a higher standard to attain to in your systems. So your business's success is going to depend on your owners or the managers receiving all the information they need to make decisions. And if you want them to stay informed, they need to see a full picture and understand how all the aspects of your business fit into place, so they can make the appropriate decision. And that's going to require transparency. That's going to require transparency in your processes and your procedures and in the information that you share out to all the owners. So accuracy and reliability is probably something that we all understand inherently, right? Like if you're trying to make a decision based on bad information or incorrect numbers, that's clearly not ideal, right? Probably not it really could mess up the path of the organization. So you obviously want it to be accurate and reliable. But then the other thing that comes from being in the world of co-ops is the role of education. So education is a founding principle of being in a cooperative, but education means being able to understand the reports. So I am an accountant, and so these reports come easy to me, but not everybody has that training. And if your decision makers don't understand the financial position or the financial health of your organization, then they can't do their job as a business owner. Right. So financial training, just like this one and a lot of other things out there, is an absolute requirement in my opinion. And I mean, I'm sure I'm biased, but I use this example and it's not hard. So, and I know a lot of you are farmers, so, and you're going to laugh at me because I laugh at myself. But while I may be a great accountant, this makes a ton of sense to me and I love it. And I've been doing it for a really long time. The first year that I bought a house, I had a yard and I decided I was going to test out the gardening, right? Like test out my skills in gardening. And y'all, I killed mint one year. Like I didn't even know it was possible to kill mint in the South, but you can do it because I did it. I mean, I just killed that stuff today. If I had tried to grow kudzu, I probably would have killed it that year too. Like it is that bad. So I'm a really smart person, but I didn't have any training, any experience in growing things. So now I'm a lot better. Now I know to put a plant in the ground and say a Hail Mary and to do some some begging to the plant, please grow there. I gave you the things I need. I think you need, but it's not great, right? I spend my time being an accountant and not my time learning how to grow things. And there's a lot of stuff that gets killed off, right? And it's not because I'm not smart. It's because this is not my training. This is not my background. And so when you are thinking about going into business with other people, you want to make sure that everybody has the education and the training they need, because that's going to be in the absolute best interest of your organization, right? You don't want your business being run the way I do my gardening, which is like a Hail Mary and, like cross your fingers and pray for rain. So, um, so where do we go from here? So what I see with most financial accounting systems that as they're getting started is that they start out manually. And by this, I mean a spreadsheet, right? And depending on how quickly you grow, that may actually be okay, right? So depending on the volume of transactions you have, if you have a spreadsheet that reports out to all of your decision makers, we got this much money in and it was for these purposes and this is what we spent money on and this is what we have to spend money on, and that is your accounting system, and that may be okay, right? The problem with a manual spreadsheet is that you're going to have to make sure that it's consistently maintained. You usually have a volunteer doing this, and that you have that added risk of having all of these manual errors. So you want it to tie into your bank account balance, beginning of the month and the end of the month. But it takes a lot of work to maintain. And actually, sometimes the spreadsheets will, in my experience, will take more work to maintain than just going ahead and moving to your second step, which is software. So accounting software is out there. 99.5% of my clients and the groups I work with use QuickBooks Online. That's not to say that we all endorse QuickBooks. It's just the one that people tend to use. And that's because QuickBooks has this awesome ability to make everybody feel like they can be an accountant. That can also be a big downfall because everybody thinks they can be an accountant. So it's pretty intuitive. And you think you're doing the right thing. So it's both a blessing and a curse. But QuickBooks Online is the product that people are moving towards. If you are familiar with QuickBooks and QuickBooks Desktop in the past, then I will let you know now that it is going the way of all the old things and it is being discontinued. So don't get started on QuickBooks Desktop. Go ahead, if you're going to use the QuickBooks line, the Intuit line, then go ahead and move on to QuickBooks Online. And then that has some advantages around security and access and a couple other things too that you wouldn't get from a desktop. There's also one called Xero. That's a pretty popular, it's gaining more popularity in the US. It is apparently the QuickBooks of like Australia, right? So it's used that much just in another country. Xero is, in my experience, not quite as easy to navigate. But if you are an accountant, then it's pretty straightforward. If you have accounting experience and you don't mind digging into things, that's your personality, then that would be fine. There's also Wave, there's Sage, and I would probably say there's some industry specific software packages out there. So these would be ones that are, if you're into farming, then it's going to be geared towards farmers. And those can be really valuable. So it's worth a Google search or worth asking around to see if there are other options for QuickBooks at a time. So the reason that the reason that the software sometimes will be easier to maintain than a spreadsheet is because they'll just pull that bank feed in. So they connect with your bank and they pull the information in and you can go through and code it, right? You don't have to worry about missing things because it's all being pulled in electronically. And so that just makes it a little bit easier sometimes, a little bit quicker. And then you don't have to worry about your one volunteer who does the spreadsheet being out, or working or having a lot of work or things like that and getting behind. Other people can access the system and do the work as well. So that can be really helpful. And then when you're designing your accounting system, if you are a nonprofit, then I would highly recommend you go over to TechSoup.org. TechSoup.org will give free licenses to nonprofit organizations for various kinds of software. So that can save you a ton of money sometimes up front, but it's only available if you are a tax-exempt organization. So just be aware of that. And then the other reminder I have down here is that we don't need to keep paper anymore. And when you are a startup organization, a lot of times you don't have a central place to work. You have various people working on various things, and you can store documents and things online. And that's perfectly fine. The IRS has said if you scan it and you can retrieve that, then that is okay. So you don't have to keep the hard copy paper as long as you absolutely can gain access to the scanned documents. And people ask me that a lot. And when you're designing your systems, then just know that you don't have to have those big copies anymore. So what financial statements are we talking about? So we're going to be talking about your income statement, your balance sheet, and your statement of cash flows. And these are the three key financial statements, and they all feed into each other. They all tell the story of your organization from a little bit of a different perspective. They give a little bit of different information, but they all are connected. And so I want, at the end of this, I want you to be familiar with these, at least enough to be able to ask questions about them. So you don't have to know the ins and outs, but just be familiar with them and kind of what each one is, how each one is telling the story. But before you get to creating financial statements, you have to make a decision. And that decision is about how you're going to report. So there are two systems, and this is the only time I'm going to use a sports analogy. I am not a sports person, but I have one sports analogy that I use all the time. And this is called, it's like, to me, the cash versus accrual systems are like softball and baseball, right? I don't know anything about softball, and I only know a little bit about how the Braves play baseball. But so when you have people on a field playing softball or baseball, I really can't tell the difference at all. But I know that there are two different games going on, and they have two different sets of rules. So accrual accounting and cash basis accounting are like that. They look very similar. They're both systems in accounting, but they're going, accrual accounting is the more complex of the two systems. So it records your revenue when you earn it. So if you do the work and you bill somebody for that, then that you send them that bill and your system records that revenue, even though you don't have that cash in yet. It records your expenses when they are incurred. So if you get to the end of your fiscal year and you have employees that have worked for you, but you haven't paid them yet, then under the accrual basis, you have to record that expense and record that you owe your employees for their time. So accrual basis is the best for businesses that hold a significant amount of inventory. So if you have inventory and you sell inventory and that's your business model, you're going to want to go with accrual basis. It might be required due to your size, but honestly, for most of my clients, then that size cap of 25 million is way over what they're dealing with. It's certain businesses, I always mention it because certain businesses can get these really big numbers, but most of the groups I work with, the size requirement is not the motivating factor. But what it can be a motivating factor, a real reason to choose the accrual basis, even though it's more complex, is because it's the only acceptable method under generally accepted accounting principles. So if you are going to apply for a loan, or if you have a lot of outside investors, then they're going to want you to be using the accounting principles that are acceptable in the United States, right? These are generally accepted accounting principles of the United States. And so that set of rules it only allows for accrual basis accounting. So if you're going to be seeking outside investment, if you have lots of owners, if you have owners that come in and out all the time, things like that, then you're probably going to lean more towards accrual accounting, even though it's a little more complex than you would for cash basis. So cash basis is like your checkbook, right? So your reports are going to tell you what money came in and what money came out. It is, pretty intuitive to us because most of us run our own homes and our own personal finances like this. You record your expenses when you pay them, you record your revenue when you get it in. And this can work really, it can be fine for small businesses, right? So under a cash basis accounting system, even though you did have employees that worked during the month of December, if you don't pay them, that payday falls in January, you wouldn't record that expense until January when you make the payment. And that is called the cash basis. It is the simplest, and sometimes simple is better, right? So you'll have to decide whether you want cash versus accrual, because once you start filing tax returns, you'll have to report to the IRS which one you're going to do, which one they're looking at. So then once you've decided that, then we can start talking about your income, your financial reports. So the first one is the income statement. And I have on your screen, you'll be able to see a kind of a simplified income statement. So your income statement is probably the one that everybody's the most familiar with when they're talking about a business. It tells the story of what's happened over a period of time. So it tells you what sales you've earned, what your revenues are, what expenses you've incurred over a period of time. So it would be like for the year 2022 or for the year 2023. Now that's different from the balance sheet because the balance sheet is a snapshot. It is one slice at one moment. It's a picture at one moment in time, but this is more like a movie or a video, something that spans a length of time. And the income statement is focused on operations. So if you look at this simplified income statement, then you're going to see like their sales and your cost of goods sold. So in this example here, we have an organization that sells its inventory. And then that brings us to a margin. That margin then, is what pays for your personnel and your operations and things like that. So it comes down that middle numbers, your operating profit and loss, and that's a pretty key metric. That's a pretty key number on the income statement is what are you making from operations? So because there's always a few odds and ends that happen, we have an other income, other expense section, but that brings you down to your net income. That net income is the driver for what's going to be, where we're going to start to calculate your tax liability. But what I want you to notice is that this is not the full picture of your organization. So this doesn't show your debt payments. It doesn't show if you have loan money that came in. It doesn't even mention cash, right? Your cash balance and how it was affected by this is not reflected here, especially if you're on the accrual basis. If you're on the cash basis, it is going to show what came in and what went out. But if you're on the accrual basis, then you're going to have expenses and revenues that maybe didn't come in and didn't hit your checkbook yet. There's also no owner investment here. And as you're starting and building and growing a business, then you're going to have owner investments. And owner investments are not reflected here. So other names for the income statement are your profit and loss, your P&L. We simplify it by calling it your P&L. Your statement of operations is what it's called sometimes. If you're a nonprofit, it can be called your statement of activities. So all of those are the same thing, right? They're all the income statement. They're all telling the story of what came in and what went out during a period of time. The next one is the balance sheet. So this one is the one that people are a little bit less familiar with. But basically, this is a snapshot of your business. So it's a picture at a moment in time. Your balance sheet is going to be dated as of a date. Usually it's going to be like December 31st, 2022, the last date of the year. It's a snapshot of what you had, which are your assets. Those are things that you have that have a future value. Your liabilities, things that you owe, right? So what you owe out to outside parties. And then your equity is your owner investment and whatever's left over after you have assets and liabilities. So another way, and this is why we call it a balance sheet, right? Because it balances your assets, what you have, minus what you owe out, is balanced by what's left over. So in your equity. And the balance sheet is used not so much for managerial and operational purposes as much as it's used by people who want to determine the health of your organization. So if I look at your balance sheet, I want to see, do you have enough cash to pay your bills, right? And so in this case, if you'll look on this one, we have the assets of this organization are some cash and some inventory and then some fixed assets. So fixed assets are like big pieces of equipment or land, houses, buildings, things like that. And then they have some liabilities. This is what they owe. So their accounts payable are their liabilities that are associated with general trade stuff, your general operations. Because I work with so many co-ops, I had to throw some patronage payable into there. Patronage is when co-ops return some of their investment to their owners. And their patronage payable is money they have due out to their owners. And so in this case, that patronage payable and that accounts payable, those are both due pretty soon, and those cost $5,000 together. And we only have $4,300 in cash sitting on the books at that moment. So that would be that's one of the things you would be able to assess from your balance sheet, that you would not be able to tell that from the income statement, right? So they're telling two different stories about your organization. If you are on the cash basis, this is going to be a lot smaller, a lot smaller, but you still will have a balance sheet on a cash basis. So, Another a group that will use your balance sheet is going to be a lender or a potential lender. So when you take it to the bank, they don't want to see just your income statement. They also want to see your balance sheet. They want to see how much debt you have, how much you owe outside of your organization. So the balance sheet is very important to lenders or potential lenders, investors. Somebody's going to be an owner and become part of your organization. They want to know what it looks like. What are they investing in? So the statement of cash flows is probably the least well-known of the financial statements, but I think it tells a more intuitive story. As long as you understand where the pieces come from. This is the one that I spend a lot of time on when I talk with boards, and I'm doing a presentation of their financial results, because it links your net income on the accrual basis back to the actual cash you have on hand. So how did your operations, how did everything affect the amount of cash? Because one thing we've all learned is that cash really is the lifeblood of your organization. Where it goes, where it came from, really, tells the trajectory of your business, right? Even more so sometimes I'd say than an accrual basis income statement. If you do or don't have enough cash, that is really the deciding factor in a lot of businesses of whether they're going to make it or not. So the statement of cash flows then links your net income, and on here they call it net earnings. So if you look at this example, it's called net earnings. I didn't have a simple cash flow statement of cash flows, so I had to pull one off the internet. So we're going to have bigger numbers here, but on this one, you can see the three different sections of the cash flow statement. So it shows your cash from your operations, your cash from your investing activities, and then your cash from your financing activities. And that's really good to know. If you want to evaluate or understand the story of what happened, then if a business is flush with cash during the year, then it may be because they just got a new loan, right? They just got a new loan and that loan was deposited in their account, and that's great. So you look at the balance sheet and you can go, oh, wow, they have a ton of cash. But it's because they just got it, right? They just got the loan and they're going to need that to pay off some things. So that may be the reason they have cash. Maybe it's because their operations actually generate a lot of cash. That's the sign of a healthy organization. Is your operations are generating the cash. And then once your operations generate the cash, you may need to pay for some stuff. So in this organization, there's cash flows from investing, and you can see that they have a negative $500,000. And that would mean that they paid $500,000 out in cash for equipment. That is an investment in your business, right? But taking on big equipment like that is an investment for the future. So it's going to have future returns, but it definitely would have affected the cash balance right now. Their cash flows from financing here, this looks like they got, they have a note payable, and that's a positive number. So that's $10,000 that came in. And so now they took out an additional loan of just $10,000, and that got deposited in their account. So this says their whole cash flow for the year was $1,522,000, right? But their actual earnings were $2 million. And so this report tells you why that is, why it is that they earned $2 million, but that they actually only but at the end of the year they generated only 1.5 million. So that can be a really helpful thing to look at. So now I get to tell you a tax joke. So here is my tax joke. So I want to give you a tax joke before I tell you all the ways the government is about to tax you. So what's the difference between a taxidermist and a tax collector? The taxidermist only takes your skin. So that is my tax joke. And I know y'all are all laughing, right? But now we get to see all the depressing things, the levels of taxation, right? All the ways in which the governments, the various levels of government are going to tax you, and the ways that you, as a business owner, it's your responsibility to know that. So you need to be aware of all the ways, because as a person doing business, you have the responsibility of knowing what your requirements are. And so there are multiple ways that we tax. Right? And I'm sure you're familiar with all of them, but it's sometimes nice just to have them laid out. So the one where I see people get the most confused is between income taxes and payroll taxes, right? So the government is going to tax your income. And some states, if you don't have income, they tax you, they apply a tax called a franchise tax. And that tax is basically for the right and privilege of doing business in their state, right? So I've seen people get in a big mess of trouble because they didn't file a tax return for a number of years. And since they were losing money, they didn't think that was a problem because they didn't owe taxes to the federal government. But their state requires a franchise tax for every year. The tax just because you're doing business. In California, it's $800 or $900 a year. So if you miss that for a couple of years in a row, it can add up real fast. And then when you put penalties and interest on top of that, it can add up even faster. So I really encourage everybody to know and understand that even though you don't have an income, you still may owe taxes you still may owe a tax. And those franchise taxes are often calculated and paid as part of your income tax return. And so you owe income taxes at the federal level to the IRS. So the Internal Revenue Service is the tax collecting agency for the federal government. But then your state has tax collecting agency as well. That's going to be your state's Department of Revenue is usually what it is. And if you're one of the lucky people to live in one of the municipalities, and it's the big cities usually, so like New York and Portland and some of the others, they have a local income tax as well on businesses frequently. And so you want to just make sure that even though if you don't make money, that you are going ahead and calculating and filing these returns so you can find out if there's any other state or local taxes that would be triggered by those income tax returns. So, and those are on the total income of your business, of your co-op, of your farm at the end of the year. But during the year, you get to pay payroll taxes. So I know most of us are going to be familiar with payroll taxes. So the Form 941s listed here are your quarterly report to the federal government. And you also file probably something similar with your state. Then for your payroll taxes that you are paying on that for your employees, and also those payroll taxes that you are pulling out of your employees' paychecks. So just a word of warning, if you withhold money from your employees and don't remit it in the time frame that the government expects you to, you can get in big trouble. They really don't like it. And when the government and the Department of Revenue and the Department of Labor and the IRS get together and decide they don't like something, then that means there's a lot of penalties. And so there can be some serious penalties if you withhold payroll taxes and you don't from your employees and then don't remit them in a timely manner. And that timely manner can mean that you paid your employees, and so you need to pay the government as well. So just be very aware of that. I actually really recommend that if you have employees, you go ahead and outsource your payroll. People will argue with that, but that's my personal opinion. Outsource payroll means that those things get remitted. And if you do it yourself, you could screw up, right? Because we're not all tax accountants sitting in we're not all accountants sitting in the office. We're out running the business itself. So the payroll taxes are remitted as you would go along as the employees work. But at the end of the year, you're going to have some informational reporting requirements. Those are your W-2s that go out to your employees. Your W-4, which has all your W-2s added together, goes up to the federal government. 1099s are also informational returns, which are similar to payroll. 1099 is a non-employee compensation. That means that that's a contractor that works for you. A 1099 PATR, which is a 1099 for patronage, has to go out if you're a co-op and you pay patronage to your people. And the threshold on that one is really small. It's like $10. So basically, if you pay patronage, then you need to fill out a 1099 PATR. The 1099 NEC for non-employee compensation is what you get if you're a contractor, and that's still at the $600 level. So probably being in farming, most of y'all are very aware of your property taxes. Usually they are levied by the county, and they are going to be due at a different time than all the other taxes. And then there's sales and use taxes. And these are all, sales and use taxes are all at the state levels. So sometimes they're also at the municipality level. And so you'll want to make sure you're aware of that. Sales taxes are on things that you sell, but use taxes are self-reported taxes. So it's when your organization is the end user of something, and so then you have to pay the tax on it in lieu of sales tax. So there come up situations where that happens. But a lot of people will miss it if they're not aware that if you are the end user of the product and you're not reselling it, then you very well may be liable for use taxes. So now we talked about where you have to pay taxes. We can talk about when you need to start filing a tax return. So technically, the year that you are incorporated is when you have to start filing a tax return. I have seen it delayed until organizations have taxable income that's being received. But technically it is as soon as you have that EIN and you have a bank account and you're incorporated, you need to start filing your tax returns. So, if you're, like I said, I have seen it delayed. Sometimes that's okay in the sense that people just start later, but really technically you're supposed to start when you get incorporated and you get a bank account. If you have an employee, oh yes, there you go. You definitely need to do it. Franchise taxes, as I mentioned before, are paid via the income tax return usually, and they're for the privilege of doing business. And so you can get behind on those in your state. And then the other question, not only when, but where do you have to file a tax return? So this is something that catches people by surprise a good bit. In my experience. So if you have an employee in another state, then you're going to have what we call nexus in that state. And that means you're going to have to file a state tax return in that state as well. So let's say I operate in Georgia, but I have one of my partners is in Alabama. And if we're in a C Corp, a corporation, then we're going to have to file in Alabama as well. If you're in a partnership, there's some ways that you can file a consolidated, or you cannot. You can do different things, but you really want to be aware of where your people are, because that's how many states you have to file in. And so if there's an employee in that state, then generally speaking, you will always have nexus in that state. If you do a substantial amount of business in one state, then you need to check the rules of that state and find out if those state rules require you to file there. So, I do business all over the U.S., but I don't have a concentration of my clients in one state. And if I did, then I would want to check the rules at least to see if the income tax rules there, if that would trigger nexus in that state. So there's, if you have just a contractor, then probably not. But if you have long-term business that's going on there, then some states it will and some states it won't. So every state is different. And so you just need to do that research. So grants, I threw this in here because there are a lot of grants associated with farming. And grants do create taxable income if you are not a nonprofit. And that can take people by surprise. So I was working with one startup co-op who got a grant. And it was from a foundation. They are alleviating a food desert, and they got a grant from an anti-hunger foundation. And that grant came in December, right? And that grant for $80,000 and it coming in the last week of December meant that they didn't have time to spend it. So all of a sudden we were looking at a tax liability on the $80,000. And so we had to do some digging and figure out what happened. Like, why did that happen? What was going on? So it turns out that grant landed in the wrong bank account. Woo-hoo. So we were able to reverse it and send it back to where it needed to go. It should have gone to their fiscal sponsor. And so if you are not familiar with fiscal sponsor relationships, then then I want you to definitely pay attention here. This can be extremely beneficial to you. So fiscal sponsors are nonprofit organizations, generally speaking, and they work in partnership with you because you are doing the work that is aligned with their mission. And so fiscal sponsors can receive the grant from, say, another foundation, another big community foundation, or even from the government, often have restrictions where their grants have to go to tax-exempt organizations. They can't go to a business. So the granting agency will send it to the fiscal sponsor, and the fiscal sponsor will oversee the grant. But you have to be careful who you choose. You want to choose an organization that is in line with the work that you are doing. So in the case that I mentioned before, it was the fiscal sponsor was an organization that supports co-ops. The grant came from an organization that fights hunger, and the co-op itself is building a store in an area that's a food desert. Right, so it does fit the mission of the nonprofit that received it. It fits the mission of the nonprofit that gave it, and the co-op is doing the work that is in line with the mission and the requirements of that grant. And so if your fiscal sponsor receives the grant, then they can transfer it to you as you do the work. And why that's really important is because you incur the expenses and you get the revenues in the same time period. So you're not going to create a tax liability because you'll have revenues and you'll have offset expenses. And so going back to my startup co-op, what we ended up doing was we found out it should have been deposited in the fiscal sponsor's bank account, and then they had an agreement with their fiscal sponsor to transfer it over quarterly based on their expected expenditures. And then they didn't have a taxation issue. They didn't have a tax liability issue. So that what you do need to understand is the fiscal sponsors do receive the grant. They do retain control of the funds. And then you have to work with the fiscal sponsor to complete whatever reporting requirements they have, whatever documentation they need. So you're going to want to have a good understanding of those. But fiscal sponsorship relationships can be extremely helpful when you're if you would otherwise qualify for a grant. So I always recommend that you document that relationship and how everything's going to work out in a memorandum of understanding between your business and the fiscal sponsor. And then the last thing I'm going to talk about is internal controls. So, and then I'm going to let Sam have at it. I like to talk about internal controls because the internal controls are what we know as checks and balances. And if there's anything that can make a co-op or a partnership fall apart, it's when the volunteers' integrity has been questioned, right? So good internal controls, good checks and balances, good strong systems, and good segregation of duties isn't hard, right? But you have to have an awareness about it from the beginning because you don't want to implement the rules once there's been questionable activity. You want to have the rules up front and everybody be aware of them. And so one of the most common mistakes I see is that all of the fiscal and financial responsibilities will fall on one person, right? Everybody else is like, I don't want to touch the money. And so all the fiscal responsibilities will fall on one person, usually somebody who's a treasurer, right? And they're like, I'll do it, I don't mind. And that's great. You definitely want to have that person who's willing to take control of the system, but you need to have some good checks and balances. So your organization isn't just worried about protecting their assets, although you definitely, clearly protecting the cash that you have is important. But you also have the responsibility to create a system that protects your employees or your other partners or your volunteers from being falsely accused. So once that happens, then it's really hard to take that back. And there's that shadow of suspicion and things just tend to fall apart. And I say one of the hardest things about being a co-op is working with people, right? Like just everybody getting along, right? That is one of the hardest parts of being in a cooperative. And so, the same holds true with being in a partnership. Going into business with a person is almost like getting married to them in some ways. And so you want to protect both them and your organization. And so those internal controls, those checks and balances, means that you take that seriously and that you are aware of them and you talk about them and you live them out in your day-to-day activities. So segregation of duties is the key principle or idea when we talk about checks and balances. And that means that one person doesn't have the custody of the assets. So that means they're not holding the checkbook, they're not signing the checks, and then they're not recording the checks in the accounting software, or they're not receiving the cash in and then taking it to the bank and recording the deposits, right? So all of those things may happen, but they have, in those situations, if you have one person doing all of those things, which I see frequently in small groups, then, and you don't have any oversight, then you have no segregation of duties. And that can lead to some difficult conversations. So my last slide here is just some practical tips, and I'm happy to share these out after this. And that's that if you have one person that keeps your checkbook, then you have another person that authorizes payment. So they get the bill, they approve it, and they authorize the checkbook signer to write the check, the signer of the checks to write the check or initiate the transaction if you do online payments. Or that there's the person with the checkbook and they can authorize the payment, but then somebody else is recording it in the accounting software or reconciling the accounting software. Always have more than one check signer. Always. I mean, people can just up and die. You know, they can they get hit by a bus. They get we all get in the pandemic. Their kid goes in the hospital. Like, always have more than one check signer. And then assign a partner or a business owner or a board member or assign somebody who is not the primary check signer to log on to the bank account and review the bank activity online fairly frequently. So this is the simplest and cheapest way to detect fraud as soon as it occurred, and then actually to prevent it from occurring because when people know that that's happening, they're less likely to make a questionable transaction. And then my fourth point is to be vigilant about the receipts and invoices to support all your purchases. So this ties into number 5, which is that as the leadership of your organization, you set the tone around internal controls. The tone at the top, how the weight that you give this, the responsibility and the attention that you, as the leadership of your organization, give internal controls and segregation of duties and following procedures, that weight will percolate all the way down in your organization. When we see deficiencies in systems, we see problems that are at the lower levels, it's frequently because those problems, the attitude at the top was, it doesn't really matter. Like, I don't have to follow this rule. Somebody else doesn't have to follow this rule. We don't require that the reports be on time. We don't require things get done. We let one person take care of things. And so that tone at the top that your board or your partner group or however you have set up, the tone that they set is going to set the tone for your entire organization. And then my last point, because I know this is a lot, is to document your roles and responsibilities of each of your board or your partner group or however you're going to do things. If it's just you and another partner, document the roles, the responsibilities you're each going to take on, what you're going to do. And this is really important, not only for clarity between you and your partners or your board members or how it's going to, but also in case, somebody gets hit by a bus, somebody wins the lottery, whatever. If they're just not available to do their responsibilities, then other people need to know what is it they do that keeps this going. So those are all of my tips, and we'll have plenty of time for questions at the end when Sam gets started. So I hope that was helpful. You're on mute.
Ron, yeah, you might be muted.
All right, thank you. Thank you, Audrey, for the presentation. And we're going to continue on with Sam and let him talk about the legalities of starting a business and what that means in terms of having a good legal perspective and a good legal background working with you to support your business venture. So Sam, I'm going to time you, say make 50 minutes.
Yeah.
Okay, great. Okay, and which leaves us about 15, 20 minutes for Q&A.
leave time for some questions at the end. Yeah.
Thank you.
Okay. That sounds great. Thank you, Ron. Thanks for having me here. Thanks everyone for having me here. Thank you, Audrey, for all the great information. It's wonderful to always talk about co-ops and help people out from the legal side of things. I'm going to share my screen, so we'll see how that works. Can everybody see? What are you seeing right now? Ron, are you seeing the presentation?
Yes, I am.
Are you seeing I guess you're probably seeing the
What is a co-op? Cooperative?
yeah, what is a cooperative? Are you seeing the program itself, or are you seeing?
I'm seeing the slides.
Okay, you're seeing the slides.
Hey, there you go. Yeah.
Okay. Yeah. So I think Ron asked us here today to talk a little bit about worker cooperatives, a little bit about how that intersects with farming and what you might be dealing with and what you might encounter, in terms of tax and legal issues as you're embarking on your farm ventures. Just to start with, you don't have to start as a worker cooperative. There are many different types of entities you could start with, many different types of business forms you could start with to run a farm. And if you are going to be doing a project like that, one of the things that you might be considering upfront is whether or not you want an entity. And in general, you will want some kind of business form just to be sure that you're taking advantage of any limited liability that entity might offer you. That means that if something happens, say someone gets hurt on the property, or you have some kind of contract that you can't fulfill, or you run out of money, the person that's on the other side of that contract, the person that God forbid you end up in a lawsuit or something like that, they can only go after the assets of the company. They can't go after your personal assets. So then you can, wrap up the company, whatever assets, they might get whatever assets the company has, but then you still have your personal assets. So that's just something to consider in terms of whether or not you want to form as a business or just do it as an individual. I figured I would start out by kind of making sure we're all on the same page as to what a cooperative is or might be. I don't really know how familiar you all are on cooperatives generally. There's a lot floating around. I mean, you're probably in your space, you're most familiar with agricultural co-ops, which are one approach and a very large approach in the United States, one of the larger approaches to cooperatives. But a cooperative can be, for different people, it can mean different things. It can be a type of business entity. Most states will have a cooperative corporation business entity, but you can still be a cooperative without being a cooperative corporation. I'll go into that a little bit more later. It's also a tax category that you might want to take advantage of. It's under subchapter T, which is a subset of corporate taxation. And that has certain benefits over, say, partnership taxation and corporate taxation. And I'll go into that a little bit more later too. It's also generally kind of it can be a cultural thing, just a culture of cooperation, a culture of working together, a culture of valuing people's input. And part of that is democratic governance. Most businesses in the United States are not cooperatives. Most businesses are just traditional corporations, LLCs, and those are owned based on capital investment, meaning they're owned based on the amount of money that people put into them. And the decision making in those businesses is based on the amount of money that people put into those businesses. So say you have an individual who puts in 70% of the investment, another individual that puts in 30% of the investment, and then people who are working on that farm. In a traditional business, the person putting in 70% of the investment will have 70% of the vote decision making. the person putting in 30% will have 30% of the vote, deciding, what the company is going to do. And then the workers who are working on that farm won't have any say in the decision making officially. In a cooperative, it's different. In a cooperative, your decision-making power is not based on how much you've invested in a company. It's based on just you as an individual. So each person has one person, or it's one person, one vote. So each person has a vote, and you vote democratically. You also split profits. In a traditional business, profits are split based on that capital investment. So the 70% investor is going to get 70% of those profits. The 30% investor is going to get 30% of those profits. And the workers will not get any of those profits. They'll get their wages, but not a share of profits. So as the business grows, the money is going to go to the capital investors. Whereas in a cooperative, the profits are split typically based on the amount of hours that you work. So if you're on a farm and say you put in 100 hours and someone else puts in 1,000 hours and another person puts in 1,000 hours, the proportions of that are going to be equal to the proportion of the profit that will be split with that particular member. So it's just in general, culturally, a somewhat more egalitarian kind of company. There are some standards for how you would qualify under Subchapter T as a cooperative. They're not as clear as they could be, but one of them is to that point that I'm talking about. It's subordinating the interests of capital to the interests of the people doing the labor. So I'll go to my next slide. So why choose a cooperative over another kind of business? One reason you might choose a cooperative is that you might not have a lot of capital, you might not have a lot of money, and you might have people. You might have a group of people that you've identified who are interested in farming with you, interested in starting a business with you, interested in starting a business on that farm that might not even be farming. And maybe you want to raise money together, and not just raise money together, but actually work together. So you're pooling your resources. Maybe you're 5-10 people, each contributing $1,000, $2,000, however much money you need, possibly more money than that, and pooling your labor together so that you can get your project off the ground. You also might choose a cooperative because of the values that you have, that you want to value each person's input and make sure that everybody has a say in how that business is run. And as I mentioned earlier, you might decide on a cooperative because you want to reward people's time spent on the project by paying them profits based on the amount of time and work that they put into it versus how much money they've invested. Now, what types of businesses can be a cooperative? It's really anything, and the type of business that you end up with is going to shape kind of how you structure that business. It's going to shape how you define labor within, like how you reward patronage of the cooperative. I have some pictures here because each one is a little bit different. Something like a yoga cooperative, maybe they have a lot of subcontractors versus, or not subcontractors, but independent contractors. Maybe instead of having a lot of employees, they have independent contractors who participate and offer their services. And so then one of the issues there and shaping that business would be, how do you include independent contractors in the decision-making process? Coffee cooperatives are a more traditional kind of cooperative and can be pretty straightforward. Computer and digital cooperatives might have issues that, they might not make so much money in one year. It's a little bit more in like a venture capital framework or something like that. They, like just in my experience, I worked with a client that would not make money for years, and it would make a lot of money in, say, the third year or something like that. So if that's something that comes up, you would want to figure out, how do you reward the people who are working during the year when there weren't any profits, from the profits that come years later, because they help build that business and get that business off the ground. And then the last one, a therapy cooperative, is one that I worked with one time, and they, license types, things like professional license types can influence who can be an owner and who can't be an owner, because sometimes there are special laws that regulate certain businesses, that restrict who can be an owner and who can't be an owner, which is just to say that in general, every business is going to be different, and every business is going to have its own kind of complexities around how you structure your voting, how you structure your patronage. So in farming specifically, I think it's good as soon as you can to have both a lawyer and an accountant on your team, both because they're going to be helping you, structure your business and get you off the ground, but also they'll be able to kind of help you avoid pitfalls. Starting any business is difficult. It's complex. There's a lot of things to learn, and you're going to make mistakes no matter what. I think for the first few years of operating a business, you might, especially if you're doing it yourself, you might end up in some tax issues, getting some communications from the IRS that you don't want. Or you might think you have something built into your bylaws, your operating agreement, your governing documents, but it's not actually there. And then if, say, someone leaves your business, and if they had a different idea of what their ownership was of that business than what you had, that can very easily spin out into a litigation. It can end up, even if it's not, even if you don't think it's a good argument, you can end up in litigation. And then even if it's not a good argument, you can be stuck in it for months, years, until that gets resolved. So a lawyer's going to help you issue spot on the front end, so you just can avoid some of that trouble, or hopefully all of that trouble. They'll also advise on best practices, especially in a cooperative. They might be helping you kind of navigate all the different decisions you might have to make around how you're structuring your governance. Are you going to have a board? What's the role of the board? What will they have decision making over? How will they make decisions? Will they make them based on a majority vote? Will they make them based on consensus or a consent style vote, which is really an emphasis in getting everyone to the same page, so everybody agrees to a decision. So there are things like that that can be complex, and a lawyer can help you navigate that. There's also a lot of just typical business matters that are going to come up as you're operating a farm, possibly even more than a typical business. You're going to be dealing with potentially real estate purchases or sales. If you have to subdivide a parcel of the land for some reason, if you're initially buying your farm, those are transactions that in some states you're allowed to do it without a lawyer, but in a lot of states you actually are required to have a lawyer if you're purchasing land. Leasing land is another thing that can be particularly complicated, and you wouldn't want to get wrong. There are all kinds of instances where a lease might come up for farming, in a traditional context where you're just leasing from another individual or a company. And then there are programs like land trusts, things like that will sometimes have more of a social mission or something like that, and be willing to work with you, want to work with you, and you can lease land from them to do farming. Even then, even if you're on good terms with the person who's on the other side, it's great to have a lease in place. You should have a lease in place, and it should say what you want it to say and consider the things that you wanted to consider, such as length of time. You probably want more than 1 year, more than 2 years, more than 3 years. Maybe you want 5 years, maybe you want 10 years, maybe longer than that. Sometimes land trust lease can be, continue on into the future pretty much indefinitely. So just a lot to consider. Ownership models, we've kind of discussed that a little bit already, but a lawyer is going to help you navigate that. Record keeping requirements to the extent it applies to your business. If you're dealing with things like food production, especially if you're actually processing that food and storing that food, there may be record keeping requirements. There's also going to be health code requirements, things like that a lawyer can help you navigate. And then if you do end up in a situation where, say you get a citation, something like that, it's good to have a lawyer that you can talk to, either to help represent you in that situation, or to refer you to another lawyer that can represent you in that situation. Also, financing, grants, things like that are going to come up. Whether or not you're raising money from new investors, which is going to bring up securities laws issues, which is a complex field of law that regulates how you can approach the public to raise money. Basically, if you are asking the public to invest in your project, then you really have to be aware of how the federal and state securities laws are affecting, are limiting what you can do and how you can do it, and to what extent you have to register those as what they call securities, which are just equity investments, and offer certain disclosures in order to make that a legal process. If you're just with a group of friends, say like five or six people, and you all know each other and you're starting a project together, that's not really a hurdle that you need to be too concerned about at that stage. But as you start to bring on future investors, people like that, it can be a real issue. Labor matters. If you're hiring people as employees, as contractors, say you have a farmhand, someone like that, or just people who are coming to work on the land, or maybe you want to use volunteer labor or something like that. There are restrictions, there are issues you might run into that are good to talk to a lawyer about. Volunteer labor is one of them. Farms, I think, typically often have people volunteering, people working the land alongside them. And technically, from a labor standpoint, volunteering for a for-profit entity is not something that's really allowed. It's something that needs to be compensated. So typically something like that in your context probably isn't going to end up being a problem, because no one's going to make it a problem. But if someone did make it a problem, then you might find yourself being obligated to pay someone back pay for at minimum wage or whatever the prevailing rate is. Zoning's another issue. Like, what can you actually do on that land that you have? Drafting governing documents, as I've talked about, and then, as I mentioned, with real estate, lawyers are sometimes required for transactions. Now, you might be familiar with cooperatives in the agricultural co-op context. Those are different than a worker cooperative. So an agricultural co-op, agricultural co-ops and electric co-ops are probably two of the biggest presences of co-ops in the United States. And agricultural co-ops are often more kind of on the scale of industry associations. They help farmers and farms band together and share resources, share things like say grain silos, or help them bring their products to market collectively, help them navigate that collectively, so that they realize some large scale efficiencies, like cost efficiencies, working together. But if you're talking about, say, owning land or buying land collectively with other people to farm, and you want to start a business for that, and you want that to be governed democratically, and you want to split the profits amongst yourselves based on the hours that you've worked, that's a worker cooperative. So it's a different kind of approach. It can be at the scale of a agricultural cooperative if you're lucky enough to grow it to that, but it can also be at the scale of 5 people or 4 people. Some states, if you're going to form under the worker co-op statute, require a minimum of 5 people. It's going to be different depending on what state you are in, but the worker co-op is like what the business that you will have with the people that you're doing business with, whereas the agricultural co-op might be a group that you join up with as a farm in order to make life easier for yourselves. Say you're wanting to start something like an intentional community or something like that, and you want to live on land together with a group of other people and farm that land. You might consider forming as a worker cooperative and making your decisions democratically, and splitting profits based on labor, and then you're squarely in the worker co-op space. Founders and steering committees. This is a note that I had from another presentation, but it's just kind of an idea of like how you're getting started with your organizing. If you're going to be forming a worker cooperative for your farm, you might have a group of people. You might have just 5 people, in which case maybe you all want to be on calls with your lawyer, but maybe not everyone wants to be on the call with the lawyer, or maybe you have 10 people, maybe you have 20 people. In which case, it can be helpful to appoint 1 or 2 or 3 people to represent you as a group with your lawyer, and just make it clear to them that these are the people who are authorized by your group to speak for the group. Otherwise, it can be sometimes a little bit of a too many cooks in the kitchen situation, and everybody can get confused, especially if people have different ideas and haven't taken the time to make sure that the group is all on the same page. So entity types, you have your choice of a number of different entity types as a worker cooperative. You can form as a cooperative corporation. Every state, I think nearly every, if not every state, has a worker cooperative statute. There might be some that don't, but that's a statute that specifically outlines the rules for it's going to have specific structures in place that if you form under that statute, you're bound by those structures. So it can be a little limiting for some organizations, and you really want to talk to a lawyer before you form your business particularly as a cooperative corporation, because you might find that there's something in that law that forces you to operate a certain way that doesn't work for your business. This could be as simple as a worker cooperative statute that requires you to have a minimum of 5 people. Say you end up just having 4 people, or you have 3 people, suddenly you're out of compliance with the law. And it's something, it would be a problem that you never would have had to cross if you had formed as a general corporation or a limited liability company and then just structured your governance as a cooperative. So that's one thing that you can do with a worker cooperative corporation. In a lot of states, they'll limit the use of co-op, like the word co-op, in your business name to entities that have formed under the worker cooperative statute. But that's really just the name of using the word cooperative in your business name, which isn't a terrible restriction for a lot of cooperatives, because you can still call yourself a cooperative. Typically, you can still call yourself a cooperative and hold yourself out as a cooperative, whether you're formed under any of these entity types. And ag co-ops, like agricultural co-ops, I don't know that you're at the scale that you really will need to consider something like that, or forming under an agricultural co-op statute, but there are sometimes special statutes and special designations for agricultural co-ops in states that are separate from all 3 of these. General corps, that's your typical corporation. It's going to be taxed at the corporate level, so it's not a pass-through entity, which means you'll be taxed when you'll be taxed on your revenue, on your profits, I believe, and then and then taxed on when you distribute those, the individuals are taxed as well. So there's a double taxation that's happening in a general corporation, whereas in a limited liability company, it is pass through. So there's no tax on the business level. There's a tax on the individual level. And so those are some considerations that you might think about when you're deciding between a general corporation and a limited liability company. Another thing you might consider is if you're interested in, say, like a multi-stakeholder cooperative, which is a cooperative that has different classes of membership. Typically, a cooperative is just going to have one class of membership, and it's going to be the workers, and they own that they own the shares. But some people want to include other stakeholders, such as people who are in the community around the cooperative. Maybe the feeling is that they should have some say in how that land is used. Maybe kind of historically dispossessed communities or something like that people want to be included in those decisions, and they may create special classes for those groups. In which case you might want to consider a general corporation because it has a structured way of distinguishing between classes of shares, whereas a limited liability company doesn't have different classes of shares, although you can carve things out to approximate that same thing. It's just not quite as intuitive of a process. One more thing that you might consider, and then I'll move on, is documentation status, like documented status. If there are individuals who might be participating in your group who are undocumented, who do not have labor authorization, and can't work as employees in the United States, one way certain groups will deal with that is to form a limited liability company, which is the people who are the member owners of a limited liability company are not deemed to be employees of that company for labor purposes, for immigration purposes. And so having them be owners of the limited liability company, worker owners, but they can be part of the business and they can work, but they're not violating immigration laws by working in that capacity. There's not really a consensus in the legal community as to whether or not the same kind of theory can apply across other entities. There are definitely some. I have colleagues that will say that you can have an owner of like a corporation and achieve the same thing, and that may be true, but LLC is the one that's been typically used, and so it's probably in some sense the safest. Just something to consider if that's something that you're encountering. Another thing is worker self-directed nonprofits. You might not be considering structuring your farm as a nonprofit, but if you are, say you want to access certain grants and you don't want to go the fiscal sponsorship route, or for whatever reason, maybe your income is going to be primarily based on grants, or maybe you're offering certain kinds of programming that are more suitable to the context of nonprofits, but you still want to have that piece of like democratic participation, making sure that the people who are working the farm are participating in decision making. You could consider worker self-directed nonprofit. That's a nonprofit. Nonprofits typically have to have a board. And a minimum of 3 people on the board, and generally the board is making all the decisions for the nonprofits. But in a worker self-directed nonprofit, the workers, they usually carve out a lot of the decisions around, like, say, your labor conditions, your schedule, kind of all the issues that a person actually working that farm that are going to be closest to their heart and closest to what they're dealing with, and put those as much as they can in the hands of the workers themselves. And also often giving the workers say in determining who's on the board. So a vote and who might be on the board of that nonprofit. Tax election, I think Audrey touched on it, and I've touched on it a little bit as well. But one of the main points here is that tax election and your entity type are not, they're not stuck together. So just because you're a worker cooperative corporation does not mean that that's the only entity you can use to elect subchapter T. You could also be a corporation and elect subchapter T. You could be an LLC and elect subchapter T. You could be an LLC and elect to be taxed as a corporation. And I think it can go the other way as well, a corporation and elect to be taxed as a partnership, depending on that. But I've never actually seen that done. Audrey could speak to that probably more. So you can still make the decision on your business structure based on what's the best structural entity for your business. And then if there's a different tax category that's better for your business, you can elect that tax category. So just in general, to go over, I think, again, to some extent, what is patronage? You'll hear this word patronage a lot in the context of worker cooperatives. And patronage is, it's kind of the system of how money flows through a cooperative. Patronage income is going to be the income generated by labor in that cooperative, and member patronage income is going to be the income generated by members of that company. And distinguishing between income generated by members of that company from income generated by non-members, like say employees of that company, is one of the things that's going to help you qualify for subchapter T. Patronage, usually though, the word is used to refer to how the profits are actually split. So your patronage is going to be the amount of hours that you work, and actually the split of the profit that you get based on the proportion of the hours that you work. So if you work 80% of the hours in that business, you would get 80% of the profits. And if someone else worked 20%, they would get 20% of those profits. And that number can be reduced too, because you can, as a group, decide to retain some amount of money in the company. In the farm context, you may have capital expenditures, things like that you're wanting to save up for. If you need some kind of implement, or you want to build a new structure or a new storage container or something like place to store, stuff that you're growing, or a new home for animals, then you may want to save up money over the course of a number of years. And so what you would do there is you would, if you're having any profits as your farm, you can decide to allocate those to the collective reserve, which is just essentially saving those, saving that money in the company for a year, years. You're going to pay taxes on that on the corporate level, but that's less. But it's not really double tax in that sense, because it's just getting taxed on the corporate level and it's staying on the corporate level, and then it's being spent at a later date. And Audrey again can speak to that more. The tax stuff I'm always learning as well, but that might reduce the amount that you're actually showing in patronage profits and the amount that you're actually distributing to the members. But the point is that's a decision that you can all make as a group to either save money or distribute it to yourselves as profit. Management and governance is also something that confuses people sometimes. Your governance is your high level decision making. It's going to be decisions that the board is making based on, like what we were talking about, how much money does the business need to survive? How much money does the business need for future expenditures that you're anticipating? How much should we distribute in profits? Should we distribute some amount in cash and some amount in a promise to pay later? should we move into this sector? Should we sell off a huge chunk of our assets? Those are large scale governance questions that are all going to be covered in your bylaws or your operating agreement. The management is different than the governance, and the management is more your day-to-day operations. It's more, who's doing the scheduling for workers to come and do work on the farm, who's making sure that supplies are ordered in a timely way. And those are management day-to-day questions. Those are not going to be dealt with in your governing documents. Those will be dealt with typically in business policies that you have, and also the authority to make those decisions can be delegated to, if you're going to have officers, if you're going to have like a president of the company, or a treasurer, some of the management, or CEO or executive director, whatever the title is, those people might have authority to decide some of like how the day-to-day is managed, while the governance is still going to be democratic amongst everyone. I talked a little bit about multi-stakeholder cooperatives. It's something that I've heard from some accountants that it can be difficult on an accounting level. So that's something to consider too. How much it's going to cost you to, have someone prepare your taxes for multiple different classes of membership. But it can be something that's useful for, say if you want the general community to be a part of decisions and participate for maybe certain decisions that the farm has. Say you have a portion of land that you're allowing people some public access onto, or public access of farming, or you're having some programming on the farm and allowing people to come and be on the farm, and you want them to have some kind of say in that, the operations of those things. You could have a separate kind of stake for them, and they could participate in an official way rather than in an unofficial way. So just to go over some key questions I think that come up is, if you're deciding between being a for-profit and nonprofit, you're going to be looking at your revenue streams. You're going to be looking, are you generating most of your money based on the services and the goods that you're offering, or are you generating most of your money from grants and things like that for programs? Entity choice, will some of the workers be undocumented? Do you need large cash reserves that might be better suited to a corporation that allows for corporate taxation? Some of these are going to be complex issues, but just things to discuss with your attorney. Does everyone want to be involved in governance level decision making? For governance and management, sometimes you're going to have everybody involved in that governance, and sometimes you're going to have a subset of people involved in governance. And so yeah, just things to consider. And then in finance issues, are you raising equity financing? Are you raising debt financing? Are you seeking grants? These are all areas that are going to involve contracts and going to involve someone having some stake in what your operations are. And so that relationship, it helps to have an attorney present while you're navigating that relationship. I think that's it from me now. I wonder, I guess we have a bit more time. Yeah. So I guess we can get on questions, or does anyone have any questions? Ron, what are you feeling?
Yeah, I'm tempted to unmute everyone so they can ask questions or share their input. Yeah. Okay.
Hi.
Is everyone unmuted?
Hello, can you hear me?
Yes, we can.
Okay, I can ask a question. In regards to the LLC, what is the best way to revert as a co-op or start as a co-op?
Yeah. So if you have, do you have an LLC already?
Yeah.
Yeah, so you've already formed your LLC, you already have your company. The step, if you wanted to be a co-op, I think first, practically speaking, you would want to identify who might be participating in that co-op and how you want them to participate. Like if you're ready to actually share decision making with other people. And if you are, and if you're committed to that, like the practical step would be, or kind of what a lawyer would do would be to draft an amended version of your operating agreement. Depending what state you're in, you may or may not have an operating agreement. Some states require you to have one. Some states allow you as a single owner, if you're the sole owner of that, to not have an operating agreement for a period of time. But once you're bringing on other people, you really do need an operating agreement. That's your governing document for the LLC.
Okay.
And it states how governance happens in that LLC. So whether or not you have one, you can always draft a new one. And the lawyer would be preparing an amended operating agreement or a new operating agreement for you that would capture those cooperative governance processes. And there are models for this out there. ICA Group has models. There are some other groups that publish models for operating agreements that already are mostly pre-built for how a cooperative will function. It's still important to have an attorney look at it just to make sure that it is saying and doing what you want it to do. But once that's drafted, you would just sign it and you're good to go. I mean, you might do a little resolution stating that we're adopting this, but in general, if it's an amendment one, you can just sign it and have everyone sign it, and then you have an operating agreement.
Thank you.
Mm-hmm.
Sam and Audrey, I got a question for you. How important is record keeping to establishing a farming or even a co-op? How important is record keeping?
I think there's a legal and accounting answer. So Audrey, you go ahead.
I'll say all the importance. So from my perspective, the record keeping requirement comes from IRS rules. So if you file a tax return, you have to keep the record supporting it for at least 3 years while the IRS that's the window the IRS has to investigate. So if you claim a deduction and you don't have the records behind that prove that it was a reasonable and necessary business expense, then they can disallow that deduction. And so in that case, then you're going to be paying more in taxes, and then you're going to be paying interest and penalties on top of those, because you now have the income, which they can show the income because they can see, maybe where it came from, but they're going to be not as friendly on the deduction side. And so they will disallow. I've seen that before. They will disallow deductions that aren't properly supported, that show that it's a reasonable and necessary business expense. And so in that case, if your return is reviewed, then you're going to pay a lot more in taxes, a lot more. So Sam, you can speak to legal. I can't even begin to talk about legal.
Yeah. Yeah, I do tell all my clients to find an accountant, find a good accountant as soon as they can, because if you're doing your own taxes, you're so much more likely to get audited than if you have an accountant. An accountant, I think, can do a lot in terms of letting you understand norms better around filing, like both making sure that you're filing correctly and understanding kind of thresholds and norms for what you're deducting, so that you're unlikely or significantly less likely to get audited. From a legal perspective, there's not. It's really depends a lot on the operations that you have, and if there are specific laws around maintaining those records. If you're just a typical business and you're not maintaining your records, but there's no specific kind of need to maintain those records. It's just a risk if you say get into litigation or something like that, and someone says that, you know, you made this decision or you didn't make that decision and you have no record of that, the presumption is much more likely to be that you didn't do it, and so you can get into legal trouble there. And then in certain fields, especially fields that are dealing with, say, like food preparation, or, you know, the nonprofit space, some of them have specific record keeping requirements, for, say, like maintaining your records for 6 years or something like that. I have to maintain my records, I think, for 6 years, at a minimum, just based on having a law license. And so it's important just to understand how, whatever industry you're in, because you might be doing farming on your farm, but you might also have other businesses too, that are operating there, or be doing other kinds of businesses or multiple business entities. It's just important to understand what the specific record keeping rules are as they apply to your field.
I'll add too that if you're with employees, right, maintaining the records and the documentation that you've done what you have to do, for the employees, having them sign, you know, whatever the elections around any benefit plans, all of that is extremely important. You can get in a lot of trouble, a lot of fines, Department of Labor, if you don't have those documents. But also, you know, if you don't keep any, like I've audited employee files that have nothing literally in them, very little. And I think and I'll advise clients, that's a big risk for your HR. I mean, if you don't have any documentation supporting the way that why you fired somebody or what happened and things like that, then that can be a problem for you later, because they can, you know, they can bring you in court for a variety of reasons. I won't even go into all of them. But if you don't have that documentation to prove, you know, that, I mean, that you fired them for cause, you know, then that can be a problem for you. Well, you know, I've actually walked away from a client, or threatened to walk away, because I was working with a co-op. And, you know, if you form a co-op, you're kind of an independent thinker, generally speaking, anyway. But I had a co-op, and they were giving me pushback. One of the members of the co-op was giving me pushback, about having to keep records and documentation for any purchase that was under $75. And I basically was like, because there is a cutoff, there is a guideline written into the IRS rules, that I was like, I'll just tell you this now. Like, I am not going to sign a tax return that has deductions that I don't think you can support. Like, I'm just not going to do it. So I told them, I was like, you know, when I prepare and fill out a tax return, then I am attesting that I believe that this is accurate. And if they are not keeping receipts and there's no approval process for the purchases that they were doing below $75, there's just so much room for fraud in that I was like, no, I will not prepare your tax return for this. So, you know, like, go find another tax accountant, but I'm not putting my initials on there. No way.
Yeah. And just to kind of piggyback on that a little bit, I had in the worker co-op context, I had a client who had someone working with them who was under the impression that she was a member of the cooperative, when they were under the impression that she was not a member of a cooperative, and the relationship soured, and she ended up being terminated, and ended up suing them, they could have settled it before, but they didn't. It was on principle, because they were very, very confident that she wasn't a member, and but they did not really have the records that they needed to back up that she was not a member. They had actually signed something that I understandably gave her the impression that she was. So it you know, things can get complex if you don't have things well documented.
Charlene, did you want to say something?
Sure, I'd like to. I'm Charlene Jean Baptiste with Giving Grace Farmers and Fishermen Cooperative, and we are an agricultural cooperative. My question is, we're here in Louisiana. My question is, where do you really find a fiscal sponsor that is really, really ingrained in agriculture and have actually maybe hopefully done some farming, been in the fields? They could identify with what your mission is, because our co-op is good. It's growing. We've studied it. But we want to make sure that we're running it and we're operating the right way.
Mm-hmm. If you're in Louisiana and you are a co-op, then the Southern Federation would be the Federation Southern Cooperatives. I always get it wrong. They would be a great resource for you. They focus on agricultural cooperatives in Louisiana and the South. So they would be a great resource for you. And then otherwise, you can look at economic development organizations. So because co-ops provide economic opportunities for people that have, are excluded from, your general capitalistic regular society, then any of those organizations, economic development organizations in your city or state, would be helpful. Depending, you would want to think, so anything that's co-op, if you're a co-op, anything that's co-op development, anything that's economic development would be the two easily ones off the top. And then it would be like what you're looking for. Like, are you looking for money for what purpose? If you're looking for money to educate young people, or to bring, to do something like that, to bring in, to, provide a pathway for, like, I'm working with a newly started fishing co-op or shrimping co-op in Georgia. And we expect to be able to get funds from the USDA because they want to train sea captains. Sea captains are going gray and retiring, and so they want to be able to create a pathway for young Black fishermen to become sea captains. And so there will be grant funding available for that and we could partner with both economic development and some of the, I forget what they're called, but it's basically like the ag extension for the ocean program. So it's like cooperative extension that goes through the university system in Georgia. There's also a similar program for ocean related stuff. Sea Grant is what it's called. So, so, it depends on what your plans are, but I think if you want to like bring food, if you're in food, then, there may be organizations like the one I talked about that would be like, that are fighting against food apartheid areas, things like that. So you kind of have to think creatively about what you're doing, but there are organizations probably that are going to do what you want to do.
So what I've in the span of my career, the economic development generally, and like to work with for-profit companies. The way we have our co-op set up on the Louisiana legislative statutes, it's an ag co-op, which is a nonprofit under Section 571. And when you work with, I've learned that when you work with economic development, they like to work with for-profits, but here's the way we went by there. We partner with all of our farmers. We have 61 farmers. We opened, I actually started in 2016, but we didn't break ground until 2022. We began marketing on behalf of the farmers to get a better price for their produce. And we started doing that last year in May. So it's been okay. It's been a little rough ride, but I believe the farmers are happy until we kind of hit a big snag here. But at any rate, we're still trying to market for the farmers, trying to find another marketing someone to market our crop. But the economic development, I haven't gone to them yet, and I didn't want them to close the door in my face. generally we can go to community development, and that works better with nonprofits.
Mm-hmm.
But we have what's called a partnership with our farmers. I am also a farmer because in Louisiana, you must be a farmer in order to create those co-ops, agricultural co-ops anyway. So it's a lot of work. And I didn't want them to tell me, well, you're going to have to find another avenue other than economic development, because they generally work with for-profits. Our only for-profits are all our farmers. The co-op itself is a nonprofit co-op, and that's the way Louisiana has it worked out. That's the way I wanted it to be worked, because we do better with a nonprofit co-op and marketing on behalf of the farmers. Economic development, I'm not quite sure. I thought maybe there was another. I know you said
The Federation of Southern Cooperatives is an amazing organization. They are, I think they're a nonprofit.
Are they here in Louisiana?
Maybe they're a cup.
They're in Georgia.
They're in Georgia and Alabama, but yes. But they work in Mississippi, and don't they work in Louisiana too?
I think so.
Yeah.
Okay.
Federation of Southern Cooperatives, and
So do they have access to who would be a good fiscal agent for our agency?
Well, if they're
a good fiscal sponsor, I'm sorry.
Yeah. So that I'm looking on their website right now to see if I assume they were a nonprofit, but they may be a co-op. They have let's see. Because what you're talking about is that you are already, that you need, like, if you work with economic development, you need a for-profit. So it's like you need the reverse of the fiscal aid.
Well, right. But economic development like to work with for-profit companies. What we're doing is we are working directly with the for-profit companies, which are farmers.
Mm-hmm.
But right. We are a nonprofit co-op.
Yourselves, yeah.
Right. And so I was trying to find a way to bridge that gap so that we don't lose any resources that may be made available to our farmers, in which by they probably don't want to go to economic development, and sometimes we don't know what to say.
Charlene, are your farmers a part of your co-op? Are they members of the co-op?
Yeah, members of our co-op, yes.
Oh, well, then you are going to be the primary conduit to go out and seek out a fiscal sponsor.
And absolutely, yes. But what I'm asking is, do you have like a list of
no,
or we don't have agricultural fiscal sponsors that we may be able to
Charlie, let me do some research, and I have your email address, and I'll email you because I'm quite sure there are fiscal sponsors out there in your region of the country. Yeah, let me do some research and let me get back with you.
Okay.
And Charlene, if you look on the Federation's website, there is a Louisiana field office in Alexandria.
Okay.
Just where you can reach out and contact them. They may be able to. They may have. They may, they would be well familiar and established with familiar with what you would be looking for. Might have some in-state resources for you there.
Yeah. Cassandra has a question here. Can they say that they're a startup and can't really afford an accountant? Can we work with a bookkeeper until tax time, then hire an accountant?
Absolutely. That's what you don't want me entering transactions, right? Because I'm too expensive. You want somebody who's a bookkeeper. And let me just talk about the distinctions real quick. So bookkeepers will record like the day-to-day transactions and do some reconciling and some oversight. And so you can get full charge bookkeepers, and they'll kind of they usually don't have like 4-year degrees, but they may have a lot of experience and a solid understanding of accounting principles. And so you would definitely want to work with a bookkeeper during the year to help create the reports, and then work with somebody who has the technical skills to do your taxes later. If you farm it out to, like, I, even as even on my own, I occasionally come into situations where I need to help a client with bookkeeping, and you don't want me to do that because my billing rate is too high. So what we'll do is I'll reach out to my network, or I have a college student who'll do some work for me and I can oversee that. And that's a lot more cost effective for my clients than me doing it. Right. Like you don't want to pay somebody, twice as much as you would pay a bookkeeper to do the bookkeeping job.
Yeah, I also just wanted to highlight Kathy's comment here that the fiscal sponsor for Charlene doesn't need to be an agricultural fiscal sponsor.
Right.
Your fiscal sponsor doesn't need to be in your field. Things you're considering with the fiscal sponsor might be how kind of like high touch or low touch they are, how involved they want to be in the administration of the funds, and also like what percentage cut of the funds they're taking. But other than that, they're just administrating, taking it so that the person giving it to you can get tax, I think the tax deduction,
Yeah.
and then they're passing the funds along, so they don't actually have to be involved in the work.
Yeah, absolutely, in that field. So before, I can't remember why we needed. Oh, one of the co-ops I was involved in a startup with, we needed to receive some grant funds to travel and send some people to a training, to a conference. And so we partnered with another nonprofit group that supports co-ops. That's all they did. They support co-ops, right? And so we are a co-op that's forming. They support co-ops, and so they became our fiscal sponsor. It just has to kind of match the mission. So you don't go to like, the Humane Society and ask them to be your sponsor unless you're doing something about animal welfare. The way that the reason the relationship works is because they can receive the money because it's in line with their exempt purpose. And so you can interpret that fairly broadly, right? But you want to find somebody who, I like what Kathy said, who's already a partner for you. They're already an ally. You're already working together in a greater good. So talk about how you can structure the grant application that would meet both of your needs, right? But it doesn't have to be just in farming at all. Like, you could do, I mean, it depends on what your grant is for, but you could have a variety of different partners, depending on what the grant is for.
Okay, all right.
All right. Are there any more questions? Comments? All right. Well, Sam and Audrey, I'd like to thank you for joining us and participating in this first of a 4-part series discussion. I'll if you don't mind, Sam and Audrey, I'll make your emails available.
Mm-hmm.
Absolutely.
Okay, yeah. Great. I'll make your emails available.
Yeah.
All
yeah,
right.
And Ron, I'll send you an updated copy of my presentation because I had made some changes after we talked at the beginning.
Okay, then. All right.
Yeah.
Great. Asia. All right. Yes, you'll be able to get the presentations. Audrey, and Sam, you making their presentation available?
Yeah, I'll send it to you right after this because I can't do 2 things at one time. So I will send it to you right after this, and then you'll have it.
All right.
I'll send the PDF version, right? Is that?
Yeah.
Yeah. Okay.
All right. Well, again, thank you both of you for joining us this evening. Thanks for all of you for participating in this first of a 4-part series. And have a great evening.
Y'all as well.
Thank you.
Thank you.
Take care.
It was great. Bye-bye.
Bye.